before we share the slides, want to ask a question. I just kind of shared the story today. Actually, I was speaking live at a conference here in London, and we were talking about the market volatility. And so I shared this story. So who here has ever old school true hitchhiked? Susan, have you?
No, I was just checking to see where is it today before we start this webinar.
Oh, the
No,
markets,
I
yes.
have never hitchhiked.
Okay. On the call, just
Have
yes or
you?
no. Have you ever actually hitchhiked? I did hitchhike one time when I was like 12 years old. Don't.
What?
Yes, I know. It was with my cousin. We got lost and then it was a really far walk home. So we got a no, a never. So when I asked this question today, it was hundreds of people in the room. Everyone said no, they've never hitchhiked before. And the reason I'm asking this is because for the longest time, right? The last basically since the 70s, hitchhiking has been very, very taboo. But it used to be something that people would do. Like in the 30s and the 40s, after World War One and Two, it was very common. And it was common all the way up into the 60s and 70s. And then the counterculture movement really took it, made it part of their movement. And then
Danger.
it had like a kind of negative connotation to it. So where am I going with this?
I
There's a
don't know.
reason I'm telling this story, which is that, again, for the longest time, it was really considered to be taboo. So when a very popular app that we all know and love, Uber, wanted to come to the market, they really had a problem, which was how do we get people to get in a stranger's car
That's so
and
true.
feel comfortable with it, right? So what did they do? They came up with the idea of this interactive map where at any point you could see where the cars are and you would feel comfortable, where they're coming from, how long till they get there. And it was really, it's not like they made the ride safer. I mean, yeah, they do background checks of the drivers and things, but really what it was doing was it was showing through visuals a hyper exposed level of communication, right? And this really, really worked for them. Rory Sutherland, an amazing marketer who I love, he said that the Uber map represents a psychological moonshot because it's not reducing the amount of time you wait for the taxi, making the taxi safer. What it's doing is simply making the wait less frustrating. It's making the idea of what you see and how you deal with getting the cab, where the cab is, how safe you feel. It makes it easier because of the visual. And so much of this I think is applicable to this topic because when we think of market volatility, we know what's going to happen. We know that the markets can be volatile. We know that every once in a while we have this happen. And yet, no matter how much we prep clients for it, they are going to want some level of communication deep down inside to reassure them and make them feel better.
And the lack of it in the taxi example just creates anxiety because it's like what you don't
Exactly.
know. That is such a great analogy. I love that.
Thank you. Yeah, I didn't tell Susan where I
Yeah,
was going with it
surprise.
before. So okay, with that, we'll do some quick intros. Susan, you can go first.
Oh, I'm Chief Marketing Experience Officer at FMG and thrilled to have all of you here.
Yes, and I'm Samantha Russell, our chief evangelist, which basically just means I get to go out and tell people all about the great things we're doing at FMG, teach the best marketing tactics we know are working. And if for some reason you're unfamiliar with FMG, we are an all-in-one marketing and texting, compliant texting platform. We have that offering now as well. And we work specifically with financial advisors. So we know your pain points and we really try to make your life easier and make your business better through the marketing technology we provide. All right. So, Susan, why don't you kick us off?
Awesome. All right. Well, we scheduled this, I think, gosh, we're probably talking about 6 weeks ago, and I've lost track of when the market was up or down, but this has been a pretty volatile year, and we've had so many advisors reach out to us and, just ask for support. And so, our clients are super nervous. We need something to communicate with them. The market's doing something yesterday. I need something today. And this is where it feels so good to be part of FMG because this is one of the times where I feel like our value is so front and center and advisors are so grateful. Um, and I think we've also hit on this a number of times because, we are fans of content marketing. the number one reason that clients leave advisors is due to lack of communications. And I would bet, I don't know that there's ever been a study that focuses in times of volatility, but I would bet that it is even more so heightened. So we
Yeah.
wanted to talk about how we could help and give you some ideas to really take like leverage this as an opportunity, as well as, obviously there's coverage that you need to do to make sure that you're keeping your clients at ease, but I think there's an opportunity to pick up clients in this kind of market too.
Oh, absolutely. And so even though things have cooled down, we hope that you'll take a lot of the resources we're going to give you, the templates, the talking points, and have them in your back pocket ready to go when you need them.
Yeah, and volatility is, I think this is hopefully what you guys have been sharing with your clients. It's not the exception, it is the rule. It is sort of the cost of investing in the market long term. And there's so many stats that we've been leaning on, and I hope you have too, and we'll share some of them that will enable you to, I think, historic perspective helps people gain confidence and feel relaxed. We wrote a do it for me blog and email and social post, and the subject, I found a quote. It was from Sir John Templeton, and it says, the four most dangerous words in investing are this time it's different. And I think every time there's been a market disruption, we all say, oh my gosh, it's different this time. COVID was certainly different than the last, than
Yeah.
the financial crisis and so on. And this feels different as well. But the historic lens on the market shows that it isn't different and it will recover, and that's what people want to hear. So throughout this presentation we'll be sharing lots of stats and charts that I think you can leverage with your clients, either in conversations or in your communications or in your social posts.
Love it. And one thing that is really interesting that I think that is about 2025 and this time is that a larger percentage of the population, higher than ever, are now paying attention and are attuned to the markets, right? So if we look, historically at who was invested, who was paying attention to what equities were doing, it was it wasn't as wide a swath of the population. We have people who are 22 years old who are following influencers and wanting to invest their money, which is great in so many ways, but there's a lot more noise. And if you look at even the media, right, we just came back up and we're back to where we were before this huge slide happened. You don't see headlines saying we're back, everybody. Like, the media makes so much noise when it's bad, but not as much when it's good. So I definitely think that contributes to it. I found, oh, no, sorry. I'm going ahead of myself. I found a Google trend that I wanted to share, but we'll get to that in a second.
Yeah, and I think, we were thinking, oh gosh, we started promoting this webinar, I guess, a week or two ago, and then of course the markets like swung back. But, as we did some research, and consumers' confidence does not swing as quickly. It is
Yes.
still, and I'd love to see, even in the chat, have your clients been reaching out? Do you feel like there's a sense of unease in your clients? And um, do you agree with us that confidence is lagging? Just because the markets have gone up in the last couple of weeks does not mean that they are suddenly like, oh, I'm good. You don't need to communicate with me anymore. I'm good.
If only, if only. Yes. Let us know in the chat. What did you experience? Did you feel like people needed more reassurance this time? Were people scared, or did it happen and come back like whiplash so fast that it maybe wasn't as bad as previous times?
Still a lack of confidence, need to see earnings. And no, because we talk about it constantly, which is exactly what we are preaching. So good for you, Carla.
Love it. So these stats are coming from a Y chart study. We've partnered with them a few years to unveil these results. And it's just reiterating what we're talking about today. So I know most of you probably are like, okay, give us the strategies, but just setting the stage. People 100% want a lot of communication, and a lot of people wish their advisor communicated more. I think that surprises a lot of advisors. They feel like, I don't want to be in people's inboxes. I don't want to be, what if they feel like I'm overdoing it? The percentage of people who say, I wish my advisor would contact me less is 1.6%. Everyone else pretty much wants more. And then we have a small segment also that are happy with the amount.
And I think, one of the misperceptions I hear is, but I know younger people don't, but this study showed it's the same whether you're, under 60, over 60. And we also, I don't think we shared this chart, but email is still everybody's preferred method of communication. And we'll get a question. I think it should come up. Actually, I'll throw it to you, Sam. Is there such a thing as too much communication? Is there a just right level of communication? And I'm talking email probably for the purposes of this conversation.
Yeah. Yes, there definitely is. I just subscribed from somebody who was sending me really helpful stuff, but it was twice a day. And it was just, it felt like I mean, I can't read that amount, right?
Right.
So, we really coach on either having a piece that regularly goes out once a week, every other week, or once a month, picking a frequency that will work for you. I think once a week or every other week would be what I would suggest, just because in our world today, how fast things change, once a month can be too little, but that still leaves room for one-offs. So even if you're sending a weekly message every Thursday, it leaves room where if something is going on, you can send a second email and it's not going to be overkill.
Totally agree. Love it.
Okay, so this is what I was talking about. Clients asking themselves, should we be doing something? And everybody obviously has different reactions. We're seeing in the chat, Callie just wrote, we haven't had much of a reaction at all. We talk constantly to our clients. I think one of the things that is interesting though, is these are Google Trends. So I don't know if anybody here ever used Google Trends. You can go and you can look at different queries and how popular they are on different days and times. So the highest popularity is 100. That's the most it can be searched for. So you can see, what should I do with my investments? This is a 2-year time frame. Basically, nobody was searching for it at all. We had a blip last summer, and now this spring, it has gone off the rails with people wondering, what should I do with my investment? Should I change it, right? And then if we look on the other chart, the Dow Jones Industrial Average, a lot of people, this is a 5-year, so it's a little bit of a longer time horizon, but you can see this massive spike of people wondering what's happening with the Dow Jones Industrial Average just in the last spring. So my point is, even if you don't hear from a client because maybe they don't want to pester you, or they feel like, oh my gosh, I don't want to ask about it, they still might be Googling and looking for information. So sending out that email, just saying, hey, here's what is happening in the markets. Here's our take on it. Here's how what we're doing, in the background for you and your investments in your portfolio. It is a reassurance because we don't know what clients are doing, who they're talking to, what they're reading online. And the trends show that this is something that wide swaths of the population are curious about.
I just was looking at that Y chart study, and one of the questions was, where do you go to find information about finances and the markets? And for those that had indicated that their advisor communicated frequently, they sought information from their advisor. It was twice 2x for those that indicated that their advisor communicated infrequently. They had twice the tendency to get information from like CNBC or just online sources, which is not what you want your clients doing.
Yeah.
So in the absence of, just like the Uber story, in the absence of information, they will seek it elsewhere. So you want to be that source of truth.
Yes. Okay, so let's actually get into some tactics now, and thinking about how we want to frame who we're communicating with and the types of ways people might be processing this. So, Susan, this was actually something that I didn't know about, these emotional profiles. So maybe if you want to share a little bit more about this.
Yeah, I mean, I was just trying to think about ways to give advice to our audience in terms of communicating during market volatility, and just doing a little bit of research. Looks like, and I'd love to see in the chat if this, like, let me know if this matches what you would say you're seeing in your clients, that they fall into 3 categories. One, they want reassurance. Two, they're like, should I be doing something? This seems like I should be doing something. And then 3, they're just like checked out. They don't care. Maybe it's time that, you need to kind of tap on them and get them re-engaged.
Love it. And I like that, thinking of it in that way. I mean, obviously, people aren't all going to fall in these buckets, but maybe tell us in the chat, which of the 3 do you feel like is the largest swath of your clients, or maybe order them, like, you have the most conservative, but some, disengaged. Where do you feel like people fall? I do feel like a lot of the advisors that we work with say very few people are saying the markets are dropping. Let me send you more sideline cash to invest. But I'd be curious to hear if maybe some of you saying, nope, that's 100% our clients. We get a ton that want to throw us more money when the markets are dropping. Okay,
So
Rob said opportunistic. He's got some.
1 and 3. It's kind of all over, but 1, 2, and 3, 1 and 2. Interesting. Okay, so it doesn't sound like we're really missing any segment. All three.
Yeah. Okay. Well, good. So we're going to give you strategies for all three.
Perfect.
So you're going to be great. Okay, so with conservative, I mean, I think this makes a lot of sense, but calming minds with clear messaging. And I really love the idea of anchoring conversations in your plans, not your predictions. And I saw a note in here from Karen who said, I watched a behavioral finance webinar. They said, never talk about your thoughts on the market, but rather focus on your services and how to calm their emotions, right? Really focusing in on the plan, what you've built with them, what we're doing, not what's happening in the markets. And she said, I think this is different from what you're saying. No, I don't think it's different from what we're saying. What we are saying, though, I do think some people like
They
to
want
kind of
proof.
hear, yeah, they want to know, like, kind of like, well, what is the reason that the markets fell? Maybe like the thoughts behind it. We're never ever suggesting, excuse me, that you should predict what will happen in the future. Ever, ever, ever. We know that that's not possible. But giving a little context as to, so these things happened in our macro environment, in the political system, and what's happening just around the world globally. And so that's why the markets are reacting this way, or maybe people think they are. Having some context to it can be a good thing. But even if that's not what you feel comfortable with, focusing on the plan is always something that will work well.
I think it's twofold. I think many of you, if you've attended one of our webinars before, we've probably mentioned our Do It For Me program, where Sam and I are helping to write content and then our team executes. Obviously, we've been very active with writing content as it relates to what's been going on this year. And we have an advisory board, our Do It For Me advisory board. It's about 14 advisors. And so we've increased, as we've met with them, we've been really asking them what they've been hearing and what they would like to have in terms of content. And that's what's really been steering us towards, it's a combination of reinforcing the plan and long-term perspective, diversification, all those key components, but also they've wanted something that would dispel this time is different and I need to panic. And that's where they've asked us to lean in on showing historic, like using visuals and charts to show what the market has done, since its origins, and using that in combination with the planning piece to calm people's minds, and that it's been very successful. So that we're kind of going from what we are hearing from all of
Yeah,
you. So I
love
would
it.
say it's complementary with the behavioral finance, not, one or the other.
And I thought this was interesting. And I don't think I would say, like, oh, you need to email people this out or anything, but this is just something I think that's really interesting. This is a chart from a very academic paper. So I've listed it down here. But basically, these gentlemen ran a study where they asked not just individual investors, but institutions and advisors, would you increase or decrease your equities allocation in response to the S&P falling between 10 and 20%? And you can see here the amount of people who would change it, right? So I think reassuring clients that this is why they hired you for these types of moments. And again, we're going to show you some of the charts you can use. That is another thing that can be a talking point, is that, and even leading up to it, like a lot of you have said this, we coach clients on it proactively so that when it happens, we don't have to do it then. And I think that's such a smart way to go.
Yeah, and that's actually, right now, maybe some clients are feeling more at ease, but for those of you that aren't frequently communicating and have a sense that their clients are just like, I'm good because I know what's going on. Our advisors talked about it. Now is the time to start laying the groundwork for the future because there will be more market volatility. But I think this also goes to that individual investor theory that we always, as individual investors, not always, tend to want to do the wrong thing at the wrong time. And
Right.
this is showing the blue being the individual investor versus the gray being the institution, like it's exactly opposite. Like when the institution wants to do something, the individual does
Right.
not. And I think again, that's why these charts, just using words is awesome, but sometimes visuals just add another dimension.
Picture's worth 1,000 words. Yeah.
Exactly.
Okay. So these are just some little talking points, little blurbs that sort of set the stage that you can then expand upon, right? Um, and I think that they're short and sweet. They're not super verbose, which is wonderful when we think of messaging that people can understand. One of my favorites is we're planning for many markets, not just this one. The idea that like we did plan for this, but also the words, your plan is built to handle it, I think is so great.
And I'd love, like, this would be a great one. I'd love to have people in the chat type in what's their go-to phrase? What have they
Yeah.
found that's worked? Because part of what is the best part of these webinars is usually when we're sharing from each other. So, yeah, we're people too. So does anybody have any go-to phrase that they found has just really resonated with clients?
Yeah. We say something in the lines of, we've planned for this. Love
Plan.
that.
Yep. Anything else? Yeah, there are a lot of different ways to cut it, but anyway, if these are helpful, hopefully we will be sending out these slides, but you can jot them down. We've been
So
through this.
people are sharing. Calvin said our industry is the only one where people don't want to buy when things are on sale.
That's awesome. Long
We plan for
time.
market declines, so we don't have to fear them, said James.
Yep, and diversification. So you guys have this. Lock, protect for a lifetime. Better to prepare than repair.
We've
Yeah,
been through this before. I think that paired with charts showing it and the rebound
yes,
is a big one.
it is a big one. I mean, that how honestly, I will say when I think it was right after maybe the market had dropped eight, I don't know, was it 8%? I've lost track at this point, but we had one of those different advisory board meetings and I know all this stuff. I even was an advisor and I was really nervous and I did feel like saying, but it's different this time.
Should we change it? Yeah.
Yeah, and it was all the charts of, and which some of which will show that made me just it made me feel more comfortable. So
Okay, so let's get into that then. And we've listed where they are at the bottom, but a lot of these, Susan, are available for people in FMG, right?
yes, they are in the Do It For Me program, but we will make this available to all of our attendees as well. These charts were ones that I found and used to create a blog, as well as versioned into, I didn't use all the charts in an email, but created an email and some social posts for our Do It For Me customers. So we thought we'd share these in case, just again, to have in your pocket, maybe to, share with your clients now, but all of these have a, sort of a different angle aimed at providing comfort to clients that are nervous. So this one, I'm guessing, let's see in the chat if you guys have seen this one before. I'm guessing you have, but this is one of the best. Showing people very quickly, if you just miss 10 days of the market, you're getting 50% of the return. And if you miss 30 days in the market, 30 best days in the market, you're getting 83% less. I mean, if that doesn't make somebody want to stay in, I'm not sure what does. And also, a lot of the charts we're showing are pretty complicated. This one is just really simple. So I love this one. Curious if anybody's used this before. Can I get the chart missing the market? Yep. Getting some people saying they'd love to see this. So this one is a great one. And let's see, we'll go to the next one. This one is a little bit busier, but what I like about this was the duration of bull and bear markets. And this was, we're not in a bear market, but knowing that even when we do enter a bear market, showing the duration and then the duration of the bull market just indicates that they have always been much shorter than the bull markets. And looking at the, average trend of the market, it just keeps going up. So this one was one that was really well liked by our Do It For Me advisory board. So we included this one in.
Yeah, you can just see the length, the colors really help magnify
Yeah.
it.
It's pretty clean. And
visually.
it shows the duration, the average bull market, 63 months. And I actually can't, I think it's like 14 months for a bear
There,
market.
yeah.
And this one, has anybody used this one? This is, I think they call this the quilt. Is that right?
Yes.
Am I saying it right?
Yep.
It's like the asset
I
class
will say
quilt.
too, this one is like a little over my head. I've seen it many
Yeah.
times. I'm always like, what am I seeing?
So I think the net is that um, diversification isn't about hitting home runs. It's about staying in the game. And pretty much any given year, there's going to be a different asset class that outperforms and, is at the top versus the bottom. And so if you try to pick it every year, you're going to miss. And it's really just the argument behind diversification. If you chase a trend and react to news cycles, you're going to probably lead to regret. And this is just kind of a visual reminder to stay diversified, focused on your strategy, and not try to switch based on the headlines. So I think from that perspective, it's a good one, but definitely needs some
Oh,
explanation.
I see. So the bottom row is
The
the
lower,
negatives and the
yeah,
top performing is at the top. But then I was thinking that the colors meant something, but that's just the same stock, like
like the
represents
sector,
different,
like the
got it.
sector.
Or the
So like
sector. Okay.
if you just did small cap, a couple years you're going to hit it out of the park, and some other years it's going to be at the bottom. So you can't, it's like picking stocks. Like you need to be diversified because it's just changing every
Changes every year.
yeah.
I like this chart now that I understand
Yeah,
it.
a little bit. I mean, I'm guessing that our audience could probably explain it way better than we are. So apologies, asterisks for messing up. But we know these slides are helpful in
Oh
communication.
yeah.
This is just another one. This gets a little more technical, but this is showing, if you're looking at 20-year time frame, then you
Yep.
essentially have statistically eliminated any kind of negative return. And each, as you get into shorter and shorter time frames, yes, you'll see some volatility and some negative, but as you broaden from 1 year to 20, you can see how little you're seeing of the red. So
This
that
in two words to me is just the phrase zoom out, right? Like if you
zoom
focus
out.
on zooming out and focusing on the big picture, just like in life, when the bad days sort of become a blip and you don't focus on them, or your growth of your business is hopefully always up and to the right. That's
Oh,
sort of what this reminds me of.
very true. And you can see like if you're talking about a 1 year time frame, the max 1 year was 53%. I kind of wonder when that was. And the min was 37, but the average is 8.6. And if you look at the averages all the way through, it's a very narrow range. They almost all have the same average, but the more narrow you get, yeah, it's going to vary widely.
Yeah, and what's really interesting too, I think, is as we're looking at these all they're not all saying the same thing, but they're getting at the same idea
Yeah.
with different approaches. And I do think it's so smart in let's say, the just over a period of time to use different charts because we don't know which ones resonate most with people.
Mhm.
So it's so nice to have different ways to look at it, to communicate it, that that one of them will resonate.
Yep. And I think the other thing, we were talking to, again, I'll bring up the advisory council because they're just kind of a microcosm of all of you, I think, reflecting multiple, types of practices, but all having the same goal. And we were debating, frequency. We were saying, like, if the market's been volatile and then, then 2 weeks later it has another dip and 3 weeks later it goes up, are we emailing each time? And I was feeling like we potentially could be getting to a point of doing too much. And the advisory board suggested, obviously don't want to do every time the market does something, send something out, but that reiterating the same story is not a bad thing. Because that's the other thing I
Yep.
was saying, like, I feel like we just did an email that talked about, use some of these charts to talk about, stay the course. And they said, using visuals that kind of say the same thing, but they're different visuals, give you an opportunity to just keep reinforcing that message. And that, like everything, if you say it once, it usually doesn't stick. You got to say it several times. And they felt that there was no downside to reiterating. And, the charts kind of give you an excuse to talk about
Yeah.
it.
there's a quote I love. It's actually really applies more to marketing. But I think it's comes from marketing, and like lead gen, but I think it applies here so beautifully too, which is that just about the time you feel like if you have to say something one more time, you're just going to throw up from repeating it, is when most of your audience is going to be hearing it for the first time, like really hearing it.
That's
So for a
perfect.
lot of you that are saying like we talk about it till we're blue in the face so our clients are good, I think that obviously is lending itself to that point.
Awesome. And then this one it gets, I sort of went from simplest to busiest, but this one is just showing from 1872 to 2024 how, I mentioned this on the last chart, but the greatest up was 53, the greatest down was 37. But when you start holding stocks for 5, 10, and 20 years, you pretty much have eliminated the negative returns. So this is kind of just exactly what the other one was, but a little bit different
Yeah.
visualization. So we just thought, and this is probably one of our shorter, this will probably end up being one of our shorter webinars, but we just wanted to give you as many, ideas and assets that you could leverage to continue to tell this story, to the point that you may think your clients are getting sick of it, but we can tell you, being a client of an advisor, there's no point at which they'll tell you to stop. But you had this
Right.
chart. What's this one?
This is one from Dimensional that I've used before. It's kind of showing the same thing with the blue and the red, but it's just basically saying that historically, after we see a huge downturn, we see the bear market, that it comes back. So it's just you
Just in
obviously can't going to happen every time, but it's showing that even in the periods where maybe it was terrible and it was really long, like we see the Great Depression, that it does come back. So just another way to iterate that same one.
I like
We've been
this one.
talking.
This one's really good. I think it's almost the same thing as one of the earlier ones, but you know what, just visually, I'm seeing the percentage up and the months better here. So I like this one.
Okay, okay, yeah. So see, they all resonate differently. But I think we've been talking a lot about our Do It For Me program, and I realized that we didn't explain what that was. So maybe put a poll up, Aubrey. If you're interested, again, all of these charts are available for people, for all of the amazing advisors that work with us through our Do It For Me program. And if you'd like to learn more about it, if you just say yes, please, we can tell you more. But Susan, maybe we should just give a quick overview right now.
Yeah, well, and actually, I think one of the next slides I'll show an example of an email, because we're talking about how to calm people's nerves. The second segment we talked about are people that are like, what do I do? So one of the things we did for our Do It For Me customers is write this opportunistic email. Ways you can go on offense during market volatility, things like, maximizing retirement contributions, which I actually did as a result of that advisory board meeting. I just front loaded my contributions to my 401k to be, earlier in the year. So I'll
Try to
max
take
out.
advantage. Yeah.
Yeah, exactly. So that's a great one, contributing to a Roth IRA, thinking about doing a Roth conversion. These are all conversations that flip from, talking to a client and trying to reassure to helping them think about what they can do now, which I think is just, we want to control. So this was a great one. So anyway, the Do It For Me program is essentially every month we're writing blogs and emails and social posts and podcast scripts and webinar scripts and video scripts and a marketing idea. But I think some of the biggest value is that we're also continually thinking of ad hoc, timely emails, timely social posts that just can be, we wake up and Sam and I are like, oh my God, it would be great to give advisors an email on blankety blank. Or we even hear from a different customer and they say, can you write me something on? And we just write it and get it out. So kind of like having Sam and I in your pocket writing you content.
Yes. So this is just a quick example of what those calendars would look like. So with the Do It For Me program, you actually are paired with someone on our team who will go in and execute this for you. So it's not like you're logging in and actually saying, okay, I'm scheduling the social post. We are doing it for you. But there's 2 blog posts that then become the basis of 2 emails that go out. And there's a version for both prospects and clients, as well as centers of influence, which I keep hearing about more and more and more. So many people want to get leads and referrals from centers of influence, but so few people actually have a strategic, systematic program to engage those COIs. So this is really, really popular. And then you can see there's also social posts, and each piece of content is in here. So when you get the calendar, you're able to go through it and say, yes, I would love to use this piece, or no, I don't want to use that. Or you can just say, yep, use it as is. I trust you, which is often what happens when people have been in the program for a while. But Susan, right, we also have marketing tips every month, which are really in depth. Like this one's a summer event where we give you everything you would need to host the event, even a planning checklist and the copy to send out the invite. So the program is so much more than just these emails, but we're highlighting them today because
Yeah,
of the market volatility topic.
perfect.
Okay, I think the last one to talk about is just the disengage. What do we do for people who we don't even hear from regardless? Is that maybe, are they the
Maybe
ones
some
that
warning
quietly end up
sign.
leaving?
I think I do think, we just even from our own perspective, there's, net promoter scores. The ones that aren't responding are the ones that you actually are more at risk than those that are responding and complaining. So quiet is not good. I know it probably feels better to have clients that are not bugging you, but I think it's a great opportunity for you to be proactive and try to engage them. So if you have those three segments, you have the ones that are just like super nervous, the ones that are like, how can I capitalize? And then you've got the disengaged. It really could be a great exercise. And I think somebody in the chat mentioned that they're going to segment their CRM and add a tag group for these three categories. Doing a drip for your disengaged, including just revisiting their goals, suggesting you get a meeting on the calendar. Certainly, if you wanted to segment your disengaged by A, B, C, D clients, you definitely want to get those disengaged A's. But it's a whole nother communication strategy to get them re-engaged. And I think that market volatility gives you that reason to reach out and
Yeah.
re-engage.
And this is the action items that we want to leave you with here, make it really easy to implement. So, obviously, we are big, huge believers, and it sounds like a lot of you are too, in proactive communication that happens year round so that when these times of volatility happen, you already have a great system in place. But you can always take it one step further. So identifying maybe top 10 clients that you can reach out to this week and being prepared to share a visual or a chart, whether the next time the market seems to be extra volatile or just even in an upcoming update to start that education and lay that groundwork now. And then adding a reoccurring confidence check to your calendar, especially for the disengaged, with really simple language, something like, we haven't heard from you in a while, we're wondering how you're feeling, and keep it really, really simple so that you get a better response rate. So hopefully these are some very tangible tips that you can leave here and implement today.
There's one question I think would be interesting to end on, which is, what do we do for clients that ask us not? I mean, the quote is, any suggestions for clients that seem to never want to hear from us? And there are people that, probably are perfectly happy, but just not, they just don't want a lot of email. Could totally be the case. Those, I would suggest that they follow you on social and just say, connect, send out connection requests to them. We have an email in Do It For Me, and I think it might be in the general library, just asking people to follow you on social. That would be great. So it's sort of, at their leisure. But again, you've got to be dripping and posting so that if they are out there looking for anything, they're seeing your information and not trying to go to CNBC to get it.
Yeah, I love that tip too, because then they're just going to see it naturally and it doesn't feel like an invasion of their inbox.
Yeah, exactly. They control it.
So
So
we
what?
wanted to share with all of you this market volatility kit that we put together. We didn't have time to go into everything, but there's samples of social media posts you can do, how you can set up a dedicated section of your website so that if the time comes where you feel like you need to be updating people regularly, you can put it all in one place there. There's the email templates and scripts that you can use. So many amazing resources that you definitely want to bookmark and have it ready to go. So everybody will be getting that along with the slides and all the charts from today.
Awesome. Well, I think hopefully nobody minds getting extra time back on their calendar, and we appreciate everybody joining us. And Sam, thanks for the Uber story. I really loved that one.
Oh, good. good. Yes, yes. Well, we said we're going to end early. It's 8:42. Oh, 8:42.
Oh, yeah.
We gave them like 20 minutes back. We're trying to keep them more to 45 minutes, but we always end up being long-winded. So I think having such a clear topic helped us this time, Susan.
Does. And just ending, the cost of our Do It For Me program is $8.95 a month. Somebody just asked that, and if you're,
Such
it
a steal.
kind of is. So feel free to connect with us, message us, and we'll be emailing out this information. If you're interested, just hit reply and we'll make sure that we follow up.
And
So
thank you all for the feedback that you found it helpful or that it was good. We really always want to do sessions that are just really helpful for all of you. So we love your feedback. If there's something you would love us to educate you about in the future, we're all ears. So please tell us, and everyone enjoy the rest of your day.
good night, Sam. Almost bedtime.
Oh, yes.
All right,
Bye-bye.
everybody. Bye.